If mortgage banking were Major League Baseball in 2001, are IMBs more like the Yankees with a big payroll or the Oakland A's about to disrupt the industry? What do you think, Jim?
Right, that's a great question. And I think the answer is there's a heck of a lot more Yankees floating around than there are Oakland at this point. You can see it in the numbers. Absolutely see it in the numbers.
Guys, you're joining a special episode of MISMO Mic'd Up. This is our Moneyball episode. I've been excited about this one probably for a couple of years, if I'm being honest, Jim. I think I first heard you talk about this maybe 2 years ago, and the whole concept. It's fun unless you're the Yankees, but it's really relevant, especially today. So, guys, welcome to MISMO Mic'd Up. We have Jim Deitch with us. Jim is the CEO and founder of Terra Verde. Your background, Jim. Of course, you're a CMB. I see you're proudly wearing your pin. Thank you for that. You're a CPA. You're a five-time author, longtime mortgage thinker, one of the best thinkers, frankly, in our space. Currently writing book number 6, if my math is correct. Disruptive AI. It's coming for you. I think that's the working title. Or no, it's coming to you or for you, I think is what you said there. And then creator of this concept, the mortgage or the Moneyball Mortgage. Uh, Jim, thanks for spending some time with me today. And I know we're going to be doing another special thing together. We'll talk about a little bit later in the episode. But happy Friday.
Happy Friday. It's a great one.
So it is a great one. We're closing out February as we record this. 2 months down in 2026. Amazing, amazing, amazing how much has changed in a short period of time already in this year around AI. And so I don't think we can say AI is coming to mortgage anymore. It's here, right? And I think that's what we're going to get into, among other things, here today. But I'd love to just start with, from your seat, what you're seeing, the clients of yours that you consult and work with. What's making this current wave of AI truly disruptive, versus prior tech cycles?
That's a great question. And AI is really two things in my mind. Number one, it's a force multiplier. And what that means is fewer people can do a lot more efficiently. And secondly, it's a democratizer because it's accessible to virtually everybody. And when you look at what's happening in the environment, and I think you're absolutely right, Brian, the last 3 months have been just remarkable. Rocket bought Mr. Cooper, Rocket bought Redfin, PennyMac bought Cenlar, UWM picks up two harbors, UWM launches its own AI agent, Mia, Compass Realty links up with Rocket. The Homeowners Protection Act, which is going to essentially reduce or eliminate trigger leads, goes into effect next week. And DHI just signed up with Title to see what they can do in terms of lowering the cost of credit. And that's just the deals that are announced. There's a lot of things happening elsewhere. And it's not necessarily AI propelling it. But if you look at all the deals that I just mentioned, what happens there is the play is on recapture on the servicing side and access to the realty community on the origination side. So just like that, you've had a major shift in market share. Not only market share among the servicers, but market share among the platforms that service. So ICE and Sagent just had a re-ranking on the league table. Certainly Rocket has really been aggressive. And part of that is it's a bet on retention on one side, and it's a bet on access on the other. And it's a bet on both direct to consumer in Rocket's case and TPO in UWM and Rocket's case. So lots happening. It's not necessarily AI triggering it, but AI is going to power a lot of the work that's to be done, not only to put these companies together, but then to access and work with the consumers once they are together.
Yeah, I think a lot of what you just described is, it's eyeball shares, right? How do I acquire as many eyeballs as possible and then apply my best practices in communication, messaging, marketing, powered most likely by some AI tools, to engage at scale with these eyeballs that I've just brought into my house, so to speak. So as you think about the parts of the mortgage process or industry, where do you think the most vulnerability sits? Is there one part of the process or segment of the industry that's most vulnerable to being disrupted by AI?
I don't know that it's a particular segment, but you opened with the Yankees versus the Oakland A's in 2001. And the reality of the Yankees, or the most expensive cost per win in 2001 versus the Oakland cost per win in 2001, was a differential of about 3-1, meaning the most expensive team spent 3 times more than the Athletics to win a game. And that kind of disparity sits right here today. And I won't name names, but there are mortgage bankers today, they're spending $25,000 to originate a loan. And the MBA average is about 12,000 plus or minus. And some of the people we work with have cost to originate as low as 6,000. Ultimately, the cost to originate is being passed on to the borrower in terms of higher interest rates. And if you really want to work on the cost of credit to the consumer and the availability of credit, one big element is how you reduce the cost of doing business. $12,000 to originate a mortgage is an incredibly high number, particularly if you're looking at a loan that's 300, 325,000, and someone's putting 5% down. You're chewing up almost all their down payment in capitalized costs, and they're paying for it over 30 years. That is, in my mind, going to change. And the people that figure out how to do that are going to win really big.
I love it. And so, Jim, the movie Moneyball, right? Brad Pitt, Jonah Hill. It's one of those movies. There's a handful of movies, maybe 3, that I can't go by without watching, wherever it is in the movie, right? And a lot of times when I'm on a plane, I'll scroll through and there's Moneyball. It's probably in my top 3. Shawshank is the other one, but that's a different episode for a different topic, probably. So just for the audience sake, let's just give them a little high level. And what's going to happen is there's going to be we're going to see the Moneyball Netflix links, clicks jump up after this episode. So Moneyball, the premise of it is talking about the 2001 Oakland A's. And the Yankees are a great metric there, but it's really the Oakland A's against everybody else in 2001, and how the A's used analytics to win, to outcompete the higher payroll teams. They didn't change any of the rules of the game, but they changed what was important and what they measured, and then how they went and found players to meet those measurements. So that's the movie. That was baseball. What is Moneyball Mortgage?
That's a great question. And it starts with a time shortly after Moneyball movie was released, and NBA hosted an event in California, and Billy Beane happened to be speaking there. Ended up sitting next to him for lunch, and we began to talk, and I asked him a little bit about the movie, and mostly about how did he come up with the idea that finding the right tools to coach wasn't necessarily technique, but it was data. And he looked at me with this. I mean, said we're having at lunch. He just looked at me. He goes, "You know what's wrong with your industry?" I said, "What's that?" He says, "Well, I've been studying it because before I speak, I want to learn a little bit about it. So I did a fair amount of studying. And you guys are absolutely the epitome of the Yankees and the Sox. You spend all kinds of money on how big your origination numbers are and how your biggest producers are. And you don't look at what's really important. And what's really important is a win. So he turned to me and says, so Deitch, what's a win? I said, that's a great question. I think it's how much money you make at the end of the year that goes into shareholder equity or owner's equity that really matters. It doesn't matter about volume. What matters is profit. And he just smiled and he says, I think that's a very good answer. Are you doing it as an industry? And I said, hell no. And we continued to talk. So as I wrote the second book, I thought I'm going to call Billy Bean up. So I called him up and we started to talk a little bit. And I said, look, it's been a while since we've spoken. Tell me what's changed. And he goes, nothing's changed. It still works. We've told everybody about what we're doing. Michael Lewis's book in 2003, it spilled it out there. The movie spilled it out even more. And everything we're doing, people know, but they don't react. They simply let us continue to do it. And that was 2018 or so. Now things have changed, right? Some people have adopted it in a big way, and the MLB has responded by, outlawing shift and some other things that data really, really helped go, but it still goes. And we'll talk a little bit later about StatCast, but I would like to get to that at some point.
For sure. Yeah, I do too. I have some personal, experience with that we could bring into this. So, so you already kind of talked about what we're measuring wrong in the industry. We're measuring volume. I see companies get excited about the number of loan officers on their team, right? So if we were to take the on base percentage, right, as a comparable, as the hidden stat, if you will, in baseball, what's that? What's the OBP in mortgage?
Yeah, and I think the movie and the book kind of simplified the on base percentage because there are several other metrics that kind of folded into that. But I would say in mortgage banking, it's revenue productivity. And you say, what's revenue productivity? Well, if you think about the biggest cost, it's the sales cost. It's the cost to originate, whether you're paying a loan officer or you're paying for leads. So what's really important on revenue productivity is it's the combination of how units, pull through, price exceptions, and mix all come together in what the gross margin is generated, net of commissions or cost to get the leads, that drops to the bottom line of gross profit. And I can tell you there's very few people that think that way, simply because it's not a concept that is obvious. And as a CPA, I think about that, and it's I don't practice anymore, but I do think about how you measure that revenue productivity. And more importantly, we've done a lot of studies on analytics for both our clients and the general data. And one of the shocking things that the MBA published in November of 25 was the 10-year history of the top 20% of the people in the industry, the bottom 20%, and the average. And it was surprising to me that the top 20% of the people in the industry earned almost 200 basis points more in profit than the bottom 20%. And that 200 basis points was pretty constant over the whole period. And that the top 20% were averaging around 125, 130 basis points, and the bottom 20% were losing 50 to 90 basis points. And it's consistent. And it just made me scratch my head. No, the average is in there around 30, 35 basis points. So think about that. It almost looks like the MLB.
Yeah.
Really, really expensive people that spend $4 million to win a game, and then you've got the people that spend $1 million to win a game. And ultimately, if you're losing 50, 60, 70 basis points consistently, you're not going to be successful. And if you're making 120, 125 basis points, do you know what you do? You don't tell anybody how you're doing it.
That's right. Yeah, that's
you just apply it and you just do it.
Yeah, that's part of our industry is that way for sure. So in baseball, of all the sports, it's probably the one that is most evident where better data quality changed everything. But every sport now, right, you can see the power of data, the power of analytics, and how it's driving the game. Like, you know, I remember, my era of the Detroit Pistons was, the bad boys, and you know, it was the first team to 80 would win the game. They're hitting 80 points by the end of the third quarter these days because now they're firing, 45% of their shots are from the 3-point line because that's what the metrics say is the right thing to do. It took all those leagues some period of time to get to, good data. And we're going to get to the fun part in a minute, but like, how bad is our data today in our industry? Like, how big of a problem is data in the mortgage industry, and specifically like at an IMB level?
At the IMB level and actually at the depository level or the credit union level, it doesn't really make much difference. The quality of the data is pretty poor, and it's either incomplete, inconsistent, or it's just not it's not clean. There's a lot of mistakes in it, and it's almost amazing. We just ran an AI agent that looked at the data quality on one of our clients, and if you looked at the key metrics, meaning what pieces of data are really, really, really important, half of it was wrong, and a quarter of it was missing. So, and that's not unusual. I mean, it's really not unusual because the industry is biased to be more focused on paper and activities than it is on the core data, and it's amazing how poor it is. And that's true on firms we do diligence on for combinations. It's true on things that we do litigation support on repurchases. It's the common theme is the data quality is pretty low.
And I would, foundationally, if you're at the enterprise level, if you're going to, leverage AI like at scale in your manufacturing process, in your workflow process, you better have your data right. You like better have a foundational excellence, around your data. It's, not to toot our own horn at MISMO, but it's why we see some of the most successful companies, they leverage, the business glossary on MISMO, and that becomes their foundation, and then they build off that. So I'm going to ask a question. We're going to kind of dig into the, AI a little bit. Based on what you're describing, I almost feel like the real competitive advantage is not necessarily AI itself, but having clean, structured, foundational data. How do you think about that?
I think about that every day because it is truly the differentiator to be able to run a business, particularly a mortgage banking business, effectively, where you have very high costs, very low margin, and the costs of mistakes are very high. The cost of a mistake in the hedging data, the cost of compliance mistakes, super high. And in some ways, we've created our own we are our own worst enemy because the data hygiene, the data structures really are not given much thought. And you see it in the industry and the regulators, and just on the MISMO side, I'm going to reverse roles with you and ask you a question. Tell me about the success on the regulator front with the common data set. Do you mind just going into a comment on it?
Yeah, I love that. So I came into MISMO about 6 months ago, and one of the first things I saw in terms of the active work streams was this mortgage compliance data set, MCD, and the work group around it. And so the MCD came to MISMO as a problem statement from two different cohorts. Almost at the same time, the Conference of State Bank Supervisors, the CSBS, which is the trade industry or trade association, if you will, for state regulators, they came to MISMO with a problem that their members brought to them to solve. And the problem was the states were asking CSBS for help for a standard on how they requested data from lenders. And today, absent a standard, you have 50 states with 50 different data requests, 50 different column headers, row labels, all the stuff, right? And so if you're a state regulator, it's going to be tough for any technology to come in and innovate on your behalf because the regulators don't have the budget to do a custom one-off solution, and there's no technology providers or builders that are going to go build 50 different one-off solutions. So this concept of standardizing the way regulators asked lenders for data was something that was important and still very important to the states. Literally at the same time, CSBS came to MISMO, one of the top two lenders, top two or three lenders in our industry came to MISMO and said, we see this problem with on the lender side where we're getting 50 different requests for the same data packaged 50 different ways, different labels, blah 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 blah. This seems like a perfect problem for MISMO to solve. And again, I wasn't here, so I'm not taking any of the credit for this, but the community of MISMO rallied together, and so this work group assembled that included lenders, legal compliance expert, technology platform providers, and arguably most importantly, the state regulators and CSBS, all at the same table working together to agree on a data standard that would drive the most impact, the most efficiency gain, and the most adoption. And I'm proud to say we published version 2.0 in December of last year, and we're now in the active adoption stage with CSBS, where states are now beginning that testing phase of this MCD. And in the conversations I'm having with lenders, it is extremely impactful in terms of the value of their investment in MISMO through the Innovation Investment Fund and the tangible return on that investment that these lenders will receive. So it's been a fun one for us, as fun as a regulatory data standard could be.
Well, it's quite an accomplishment, and I know that the cost of regulation is often cited as one of the cost drivers that has increased the cost of credit. And being regulated by 50 states and territories, if you lend outside the 50 states, there's, I believe, 66 or 67 different opportunities to interact with an agency, not including the federal agencies. So to get a common data set seems to have the potential to reduce a tremendous amount of both friction spent providing data, but also misunderstandings. I'll give you an example, and obviously we'll keep the names anonymous. And even it was not a mortgage lender; it was a different client that was in a different type of lending, and they had a fair lending issue. And the reason was that if a loan didn't have the required data set, the answer was, oh, it's a decline. So this particular lender, which was a national lender, had declination rates which were orders of magnitude higher, but they were data integrity issues. But it triggered a fair lending issue, and it took a lot of time and a lot of effort and a lot of money to simply solve something that was a misunderstanding of what common data element means. So the benefit of what we would get from a common denominator of data sets extends beyond the regulatory community. It really goes into the ability to innovate. And if you think about it, some of the people that I interact with that are building AI-driven technology can use a common definition, a common data set to instantly get credibility and commonality and understanding of the data sets within our industry. And that is a strategic advantage for non-incumbents that are coming in. They can say, here's what I'm going to do, and I can apply this technology. I can absorb this schema and very rapidly build tools that can serve the industry. So in some ways, new entrants are at an advantage because they don't have all the legacy issues in their systems to deal with, and they can start with a common data set. So that's one of the elements that really powers AI is the ability to have a common data set or to know what the standard is and detect differences so you can heal that data or correct that data.
Love it. You and I could talk for hours on this, and the good news is we are going to talk for at least another full hour. We're setting up a webinar together. I'm looking forward to that. When we publish this episode, folks, we're going to have a link to that webinar so you can tune into that. We're going to go a lot deeper. But I have one more question, Jim. I want to get to a conversation you and I had when we were together in a meeting a few weeks back, and you were describing how the enterprise that is Major League Baseball, right? The league, how it invested in its own data for all of its franchisees, the teams, and how that's really driving, the value of the industry, the enterprise, but also obviously it's driving franchise value. And we're all of us as fans live and see this and breathe it every day. Talk to us about the StatCast revolution that really propelled MLB and its data strategy, and then give a glimpse in how we can do the same thing in mortgage.
Well, StatCast is an MLB sponsored technology initiative, and it was determined that having a common data set among all the different teams and then making that data set in its most disaggregated way available to the MLB teams and to a more aggregated way available to fans. You can go on to statcast.com and you can find any play, any situation, anything you want to know about a particular player or a particular game or a particular game situation, down to where the pitch actually went across the plate, how fast it was going, if the hitter made contact, what the launch angle was, what the speed off of that was, what direction it did, spin rates, literally anything. And there's 14 cameras throughout each park. The data collected in a single MLB game is around 7 gigabytes. So if you took the whole season of all the games, you'd have 23 petabytes of data. And before we had a conversation today, I was looking at the World Series and Ohtani in particular, and just looking at his stats and looking at what the outcomes of that was. And if you haven't been on statcast.com, even if you're not a baseball fan, it's worth it to go to see literally the ecosphere of data that can be collected on players. And taking it back, to Moneyball, I did ask Billy when I talked to him the most recent time was, how do you actually use this? And he said, we really use it. I mean, a good example is Hattenberg. I mean, we picked him up. He was a catcher. He couldn't throw anymore, but he could get on base and he could hit, and he was reliably on base and he didn't get shaken. So they took the characteristics of what someone would call a flawed player and reconstituted that flawed player into someone who, and you can't make this up, hit a walk-off home run in the 20th game to extend the streak when they're ahead 11-0 and basically blew it. So it's a great Cinderella story, as Bill Murray says, but it's also true in our industry because I look at individual loan officer performance, and you can see the same types of opportunities. Here's a loan officer that with the national lender, we look at pull through rates as high as 91% or as low as 10%. Think of it. You're batting 240 or you're batting 900. Think about reputationally. Think about credit costs. So all these things are there that really have the opportunity to improve customer experience, to improve lender profitability, and they're sitting in your systems even in the flawed data state, it's still good enough to get a strategic advantage way above your competitors if you apply it. That's I think the hope of what we can do here to really reduce the cost of credit to
Yeah.
to our borrowers.
I have a great example, and then we'll close it out and leave something for our webinar that we're going to do together. But I interviewed a loan officer at the New England Mortgage Summit, and Kelly Turner is her name. I'm going to shout her out because she deserves it. And Kelly's built a personal brand in her community, but also digitally, to the point where she's her own kind of direct to consumer channel, right? But to give you an idea of how important data and metrics are, her company, Total Mortgage, I'll also shout them out. Like they really understand the power of metrics. And so Kelly, at any given time, is the top performing loan officer in number of days from application to clear to close. And so if you think about that one metric, right? I take an app today and 11 days later, on average, I get a clear to close. I think that was roughly her metric. Why is that important? How does that impact cost to originate, pull through? Well, the faster you do things in our industry, the less time the consumer has to get distracted by other conversations and offers and whatnot. I actually think that the soft side of consistent, reliable, fast, if you will, is lowering the anxiety of the home buyer to the point where the agony of the process now can become enjoyable. To the extent that applying for a loan is enjoyable. And so to me, it's a great example of a single metric that, by the way, it's also playing out in the form of number of loans closed and I'm sure profitability for somebody like Kelly and for Total Mortgage. But every lender should be looking at metrics to that degree, and being focused on it and rewarding the right behaviors. So Jim, like I said, this is our tee up for our webinar that we will be doing shortly, guys. We are going to be doing a LinkedIn Live webinar. We'll be promoting it out. When we publish this episode, there'll be a link to register in the details here. But Jim, I appreciate you coming on and spending a half hour with us on MISMO Mic'd Up, and I'm looking forward to spending more time with you. And guys, go out there, hit Netflix, check out the Moneyball movie. You won't be disappointed.
So Brian, thanks so much. It's a pleasure to be with you and great to see you again.
All right, guys, thank you so much. Come back next Friday for our next episode of MISMO Mic'd Up.